Big question today, chaos, global chaos when it comes to crude oil, supply and demand across the entire globe. Investors of all caliber, all sizes, all net worth, all liquidity are saying, how do I play the crude oil? How will crude oil, shortage in supply, rising prices, how is that going to affect the investments I've already made? How is it going to affect investment decisions I'm making today? And maybe, where are the opportunities that I can look at in terms of benefiting from the rising price of oil? Well, fundamentally, there's two things you have to think about. Do you think that the price of oil is artificially high today and it'll fall back to pre-Iranian war prices? If so, it's a short-lived economic event. It's a short-lived opportunity to be able to participate in the rise of price of crude oil. If you believe this is really a shift in the way oil and gas is treated, if you believe there's a shift in the pricing model and the foundation of the metrics of oil prices globally as a result of the Strait of Hormuz being shut down, a realization that every country is short and deprived of the necessary byproducts and raw material for oil and gas and fossil fuels in their country, and this is going to be a longer, protracted rise in prices for higher for longer, then you have to start figuring out how to play that market. I'm not a financial advisor. I'm not giving financial advice. I don't have a brokerage firm. I'm just talking to you as an oil and gas industry expert for 41 years and telling you what I think. First off, it's very difficult to play what I call service companies. Service companies are like the sun. They come up and they come down. If you can catch it right, maybe you see the sun rise and you last long enough to see enough profit you can get out before it goes back down. I don't really care for service companies in terms of my own stock decision making because of what I just described. What I really want to do is I want to say who's going to benefit long term from the rise of price of oil and gas. It's going to be probably the producers and the end distributor. Like an LNG facility takes product, compresses it, turns it into LNG, and delivers it to a customer. It's like buying toilet paper. It's getting used every day, all day, and you got to buy new rolls every day, all day, because that's what happens in nature, right? Same thing happens with oil and gas. We're consuming 101 million barrels a day. That oil and gas, that 101 million barrels will never be on planet Earth again. So we got to find another 101 million barrels for tomorrow and the next day and the next. So if you're looking for an investment, you have to think about the continuity of that energy investment in terms of what it does for you, whether you're buying stock, you're buying bonds, you're buying ETFs, or you're buying directly into oil and gas mineral rights, drilling programs, whatever you're doing. So when I think about the chaos in the world today, I may also see what kind of businesses will be negatively affected because of rising price. I'm going to figure out what might benefit as far as industries because of the rise of price of oil and gas. And I have to determine, in my own opinion, is this a short-term scenario or is this a long-term, more of a shift for a longer protracted period of time in terms of repricing energy around the globe? One thing I might suggest, take a look at your large exploration and production companies. You can look at Exxon, Chevron, Diamondback. You can look at all these different companies that are big-time producers in the Permian Basin, Williston Basin, Marcellus Basin, the Anadarko, the Eagle Ford. And you can look at their numbers and say, which companies have diversification in terms of gas versus oil? Which companies have control of drilling rigs, because there's not very many drilling rigs left to put to work. So whoever controls the rigs controls the drill bit. Whoever controls the drill bit controls future supply. So with you looking at different investment opportunities, you might say within the E&P, exploration, production, public equity market, which company is best positioned for doing incredibly well with rising prices? Well, I can tell you Exxon is a great one to look at. I've owned Exxon since 1991. My kids have Exxon stock for 40 years, right? Why is that? Well, they own refining and they own production. So when oil prices are low, the refining business does incredibly well because the spread is larger. When oil prices are higher, the refining does less successful business and less successful profit margins, but their E&P side, the production side, does incredibly well. Well-balanced company. I also want to look at who has control of the rigs. If I'm drilling wells today and the price of drilling hasn't really gone up at all, reflected to commodity prices, I'm drilling at a really cheap price with almost 40 to 80% increase in the value of my commodities. Another thing to remind yourself, the reserves in the ground. At $60 a barrel, my reserves are worth X. At $100 a barrel, my reserves are worth X times 70%. So the inflated value of the stock, the value of the assets owned by these public companies is naturally going to go up because the reserves in the ground are worth more money. As an investor, when there's chaos, there's opportunity. Remember, if you have everything status quo, right? There's no arbitrage, there's no value. You can't make money when everybody's paying the same price. When there's no differential between buy and sell, there's no arbitrage. What you're looking for is a differential in arbitrage opportunities and how to play that. I look at it very simply. Today, I believe we're going to be seeing higher prices for longer. The new basement price for oil, crude oil around the world is probably more like $85 to $90 a barrel for the next 36 to 60 months. And if I'm in that camp, which I am, and you're in that camp, then I want to know who's going to benefit from longer, higher prices relative to what I just described. To me, that's going to be exploration production companies. It's going to be probably necessary service companies, those who make wellheads and tanks and pipe, because guess what? There is no second pipe company, no third wellhead company. There's only a certain amount of suppliers of necessary equipment. If that's true, they're going to charge more because there's going to be a higher margin of profit. The oil company's going to have it. New players will enter the market. They're going to compete, and that's going to drive what I call necessary products. It also has to do with when the price curls back and goes down to a normalized level, maybe from $100, $110 a barrel back to $75 or $85 a barrel. Who's going to get cut first? Frac companies are going to be slowed down. Permit companies, people who make pad sites, what I would call those initial forefront service companies are going to slow down when the price comes down. But it's not going to slow down in terms of wellheads and tanks. It's not going to slow down when it comes to meters and gauges. It's not going to slow down when it comes to the production side equipment and services like recompleting wells, service companies that service wells and need to have the tubing pulled. What you're going to have is more wells to service, which means more income to be made. Look, you'll make your own decision. Oil and gas is a fantastic industry. We have a massive opportunity for arbitrage. There's lots of ways to play this game, lots of ways to take advantage of the market price of oil going up. You have to decide what's best for you. To me, chaos means opportunity. Figure out how to play the game. That's what I do.